Welcome everybody to the Talent Market 30. The goal for today is to take you through what has happened in global talent markets across the globe in the last 60 days in 30 minutes or less. So I hope that it will be very interesting for you and you will learn a lot. I'll take you through the agenda for today. So we're going to cover a couple of things. First, I want to start off with a bit of a pulse on what is happening in global labor markets, how are things moving, and what does it mean for the bargaining power between employees and employers. Then I want to put some things that have happened in the last 60 days into context. For example, the stock market correction that started in Japan and also had its effect across the globe. What does that mean for labor markets in the world? Then there was a very large job creation revision by the Bureau of Labor Statistics in the US. So we're going to go and dive a little bit deeper into what triggered that and what does it mean. Then we want to look a little bit further into what has job displacement done in terms of as a result of AI in the largest tech companies. Can we see examples of job displacement, and is that an indicator of what is happening next? And then I want to highlight some research that was recently published by McKinsey that can be very helpful for you to be aware of to have the right conversations within your company. After that, there will be some time for a Q&A. If you have any questions, please add them to the Q&A box. Then they will get to me and then I'll answer them during the Q&A. And we'll finish off with looking forward to the next 60 days. What can you look out for and things that we'll probably report back on in the next series in 60 days from now. So I hope that's all clear, and we'll start with the first topic, the 60-day pulse. What's happening? What's the status of labor markets globally? So first of all, I want to introduce this power dial to you. That power dial is based on a lot of metrics, such as unemployment rates, job openings to job seekers ratio, the real wage growth, so wage growth minus inflation, the number of quits, so people that voluntarily left their jobs, job vacancy rates, also the trends in remote work, is that being offered more or less in the market, and also the number of job ads. So all this combined, we put into this dial that shows the bargaining power from employees versus employers. So if it tilts completely to the right, then the bargaining power is in the hands of employees. If it tilts completely to the left, the bargaining power is with employers. Now, maybe not to a surprise of you, in most markets, we see now that the bargaining power is firmly in the hands of employees. We do need to say that it has come down for a little bit. And let's first look at maybe the number of job ads globally, especially in the US. We see that peaked in around the first quarter in 22. And somewhat unusual, this has already been going down for 2 years. And that doesn't happen that often, that we see a decline in job vacancies for that long period of time. In history, you usually see a fast decline when there's a recession or a recession coming, and then it quickly picks back up. Now we see for a prolonged period of time, we see already that the number of job ads that are open are declining for a while already. Now, I do believe that in some countries, this trend has probably hit the bottom at now. In the US, for example, we see that it starts to stabilize, and further on, I will make the case that potentially could go up over the next few months as well. The UK, you see that the bargaining power is a little bit less. It's almost even. You see that the UK economy is doing a little bit less good than, for example, the US. But overall, the bargaining power is still a bit more with employees than with employers. The Netherlands, you see that there's still a very tight labor market. That dial is really also influenced by the bargaining power that Dutch talent has at the moment. When it comes to salaries, we still see the salaries increasing quite rapidly, whereas in the US you see that the real wage growth is actually declining at the moment compared to previous months before. So that gives a little bit of a feeling on what's happening in the markets. Not every market is the same. Southern Europe looks actually quite positive. We see demand picking up there. But in, for example, Germany, we still see that it is in a declining trend and that the job ads are still declining. So I hope that gives a little bit of a feeling on where job markets are at right now, and we'll go into the contextualizers. And I wanted to start off with the stock market turmoil, especially in Japan, where there was a 12% decline in the Nikkei. And that was the largest decline since Black Monday in '87. So that's a very long time ago. And that means that something must have happened, right? So the first question, of course, is what has happened there? Well, the trigger was that there was a sudden interest rate raised by the Bank of Japan. They decided that they thought it would be a good moment to raise interest rates. But that actually caused a sudden unraveling of what is called the yen carry trade. So what does the yen carry trade mean? Is that a lot of investors were borrowing money in Japan to spend it on US stock markets because it was very cheap to borrow capital in Japan and then spend it in US stock markets where they still saw some good returns. Now, if the interest rate suddenly goes up, that means that the yen in price is going up against the US dollar, and that meant that a lot of these investors suddenly had to pull back their money. And that caused the yen to further go up. And of course, if a strong yen, if for an export-driven country like Japan has some issues, and that meant that there was a sudden decline in the stock markets. Now, there are also some other reasons why that happened. It all came together on that day, but the 5th of August, but there were some underlying issues as well. One was the geopolitical tensions. You can think of that was the moment where Ukraine also started to invade on Russian territory, especially in the area of where there was a crucial gas pipeline. And also, possibly even more important, around that time, Goldman Sachs released a report on AI. And their main take on AI was there is currently already 500 billion in capital expenditures, investment in AI done by a lot of companies. But when they're actually looking at what does that market can return, it's probably around 100 billion. So an investment of 500 billion versus 100 billion in return, they said, well, we should be thinking that we're getting into a territory where AI is overhyped. And the reality is that there's no real killer app in the last 2 years since ChatGPT, and probably stock markets have gone too far ahead when the returns from AI are not there yet. Now, what does that mean for labor markets? For labor markets, actually, the impact will be quite minimal. Why am I saying that? First of all, most of the stock markets have recovered. They're back to their pre-August 5th heights. What it does mean is that it indicates there's still quite a lot of economic uncertainty around, and that actual uncertainty leads to a more difficult business environment. And we're in this period in time again where a difficult economic uncertainty can actually help stock markets in a way that it is a reason for central banks to cut interest rates again. Now, Jerome Powell, the chairman of the Fed, has already indicated that in the September meeting of the Fed, they will reduce the interest rates in the US. The ECB has already done the first rate cut. And also, the question is a little bit, what will happen next? Today, it was announced that German inflation has gone to 2%. 2% is usually the moment where central banks are looking at. That's the sweet spot for inflation. And they are, when they're at that point, it is a safe point to cut rates. Now, why is that interest rate so important? Well, first of all, when interest rates go down, it just means capital gets cheaper. If capital gets cheaper, there will be more investments. And if there were more investment, the amount of the demand for talent will go up. So that is a large part of the reason why I think that we have bottomed. Once the interest rates will be cut, we will see investments going up and the demand for talent going up. Now, there is a difference there's a time difference when that happens and when that actually impacts labor markets. To give you a little bit of a feeling, when they started hiking the rates up, that took about, and usually takes between 12 and 18 months to actually have an impact on demand. In that case, that the demand would actually go down. But the rate cuts could potentially go faster because it's easier to start new investments than it's to stop new investments. And so I do expect that that the demand is either stabilized or will slowly going up. Will it go up very quickly? Probably not. But will the downtrend of the last 2 years stop? I firmly believe so. The next contextualizer that I wanted to give you is around the job growth revision in the US. Now, the US is a market that I will always be looking at because a lot of the times we'll see trends in the US cascade from the US to other economies. Usually there is a time delay between 6 months with Europe and 9 months with APAC, but actually then job growth being down in the US is important for all global labor markets. So what happens? The Bureau of Labor Statistics said that in the period of April 23 to March 24, there were not 2.9 million new jobs in the US created, but 2.1. So a significant revision in job growth, and actually the largest revision since 2009. Now, revisions are completely common. That happens quite a lot, but such a large revision down, of course, is something that you want to keep an eye out on. Now, what triggered that? The BLS hasn't said why that has happened. But of course, there are a lot of theories on what happened there. It can be that there were sampling areas. This is not, it is a sort of form of science, but maybe not as exact as you might be thinking. They survey business owners and other groups to find out what does that job growth look like. And it's possible that they had a sampling error in there. The other potential issue that they have is that they had a birth-death model that predicts certain elements in the models that they're using, and they change the assumptions, and that had a large impact on the overall number. And there's a third theory that also is quite interesting, if you ask me, and that is that they might have counted in those 2.9 million jobs created undocumented immigrants, and they're technically not allowed to count those. But the question, of course, is, does that mean that those jobs were not there, or were they there? That is not completely clear. And that is especially interesting if you think about what does that mean. I'll go into that a little bit further when I go into the research of McKinsey and what that means if jobs are not filled. But it is interesting to keep that in mind. What does it mean? Well, actually, the job growth in the US is still outpacing population growth. So overall, that is a good sign of the economy, that job growth is still outpacing growth, and then in job opportunity on average is still growing. It is a bit unclear of if the demand was still there or if this was a demand issue, but in general, it looks like a very healthy labor market. And of course, elections will influence the labor market tightness, especially if you can think of if those jobs really existed and Trump would win the elections, and the plans then to deport a lot of the undocumented immigrants, that could have a real impact on the labor market as such in North America. Um, Then next up, one thing that I wanted to highlight and something that we've seen, and the background, of course, was when in November 22, OpenAI launched ChatGPT and started a revolution. And if you look at all the media coverage, then there was a lot of fear in the headlines that, oh, AI is going for your job, and we expect massive job displacements. Now, the reality is, if we look at job displacement as a whole, we don't really see that yet. And that made us curious to see what's actually happening in the largest tech companies globally, the Magnificent Seven, companies that have fared very well on the stock market, and what's happening in those companies to see if there's any job displacement there, and if that's an indicator for other companies that job displacement might be coming to everybody soon. Now, the reality is, and you can see here the numbers, that the growth in certain job areas that you would expect potentially to be affected by Gen AI is still very strong. So you do see that data clerks within those 7 largest tech companies globally is still growing. Same as customer service. These are still places where these companies are adding, and it's not necessarily being replaced by AI. And that's something that we see wider, is that almost every company, I don't think I've spoken to one company yet that isn't experimenting with Gen AI. And there are definitely some successes in the use of Gen AI, and definitely some impact. But as a broad change in job or real job displacement, we don't see that yet, and we don't see that in these companies as well. And I do think that there is a other indicator that backs this up, is that if we look at how is the revenue or profit even by individual FTE in these companies evolving, we don't see a massive spike in productivity either. And I think this is the reality where we are now in the market. This always reminds me of a quote from Bill Gates, who says we're probably overestimating the change that will occur in the next 2 years, and we underestimate the change that will occur in the next 10 years. And I think what we see with Gen AI is the traditional hype cycle. Initially, everybody's very hyped and there's a lot to do about it. Then the initial results are not as big as then initially said, but I do think the change will be profound. So if we look back to 2034, or we look forward to 2034, I do think we will see profound changes, and we do have indicators that this will include job displacement. Why do I say there are some indicators for this? Well, if you look at the contingent market, you do see some skills, especially related to language, that we see the demand going down, especially in the freelancers area. So that's something to look out for. But has there been a massive job displacement as of yet? Not really. Then the last topic for today is research that was released by McKinsey recently. There was a publication called Help Wanted, charting the challenge of tight labor markets in the advanced economy. And I've taken a screenshot of that on the right. You see that one where they have charted the surplus of workers. So if you see that first bar, 24.4, that was in 2010. There was 24.4 surplus in workers in these advanced labor markets: US, Japan, Germany, Canada, UK, Italy, France, and Australia. And the population of these countries have grown with 30 million. There are 20.9 million people that have joined the workforce that were not working before, and have led to an increase in supply. Aging and retirement has driven that down with 18 million. And then there were 31.3 million jobs added that kept the unemployment rate at a stable level as it was in 2010. And there were even more jobs created that actually reduced unemployment with 15.5 million. And if you then add the number of job vacancies there, so 9.9 million job vacancies in these countries, you can see that the surplus of available workers has gone down to 1 million. So in 13 years' time, we've gone from a relatively okay, normal surplus to completely disappearing that surplus. And I think what this publication from McKinsey shows really well, also in different charts, is to show how tight these labor markets have come, and that right now in the 2-year decline already in demand, that this is not something that will continue, that there is a structural issue when it comes to talent scarcity. And my take on that is that we saw a lot of labor hoarding, a little bit of overhiring during the pandemic, and that's now bubbling out, I would say. But the reality is that the issues are structural and that talent scarcity is here to stay. I think the publication from McKinsey shows that really well. I really recommend having a look at it because they really show in different graphs, in different views on why it's here to stay. And especially if you combine that with another publication that they did in April, and that screenshot you can see on the left, you see what the impact can be on an individual company. So on overall, as a global economy, for not filling those jobs in 2023, they expect that the loss of GDP was between 0.5% and 1.5%. So that's very significant loss in GDP because we're not filling those jobs. And then the other publication from McKinsey is called Increasing Your Return on Talent, the moves and metrics that matter. They have calculated that the average cost for a vacancy is $52,000 US. So that's the cost of missed revenue, having to onboard somebody, having to find somebody. So that really shows what the impact of an individual vacancy is. And you can imagine if the cost of this in general for a company, they estimate that for the average S&P 500, the median S&P 500, this goes almost up to $500 million in costs on an annual basis. And I hope that helps you think a little bit on how big these numbers are and what a difference it makes in 1% of your attrition, higher or lower, and the impact on your overall business on that. And I think the McKinsey publications really make that case really well. Also, the other publication went into, okay, now you know this, what does that mean? And I wanted to highlight a couple of things on what they say that you need to do as a company to deal with that. First of all, you need to identify really like which talent you need to win, which talent is crucial and you need to attract as a company. They say you need to create a hiring engine that is able to compete for that talent, that is efficient, that is attractive. It also goes into how to organize L&D and to focus on the highest returning L&D because there is a lack or there's a skills imbalance, of course, there as well. And they talk about how do you create a performance culture. So really recommend that as well. So that leads to the Q&A. If you have any questions, pop them in the Q&A box. I already see some questions coming in there. Hi, Joost, could there also be an effect of a lot of fake vacancies being measured by aggregators? Yes, absolutely. There are fake vacancies, and it is hard to duplicate all the vacancies that are there. But I do think that as long as vacancies are measured in the same way, the trends should be in line. And of course, it is hard to judge on what is the exact number. I do think that it has gotten a little bit better over time, but it is hard to say. But as long as job growth is still there, and for example, in the US, still outpacing the population growth, it's a good indicator that the labor markets are still very. Next question, please share the McKinsey publications. Yes, we will give you the links to these two publications that I think are very good. And I understand from my colleague that this has already been sent to the person asking for the links. More questions coming in. What's the name of the McKinsey report? Do you have a link? So Martin Thomas, yes, we will also share that with you. Another question, has some of this result being the elections globally causing a short-term nervousness? Yes, although I do think you should overestimate this. In general, a lot of the changes in policies are relatively minimal and not immediate. You often see a stock market response, but for example, if you go back to 2016, when Trump did win the elections, the stock markets first went down, but the next day they went up a little bit. Now, it can contribute to the nervousness in the markets on what the results are, but we shouldn't overestimate a change in sides in the US, I assume in this case, on the immediate impact on the labor market. If there are more questions, we have probably a chance to answer one or two more questions. Yeah, there's more questions coming in. There's a question on what's the one thing that companies need to do to tackle labor scarcity. I find it hard to say one thing because I think you need to do a lot of things to tackle these issues, and it's not just one fixes all. I do really think that it helps to understand what are those crucial skills in your company, and do you know how attractive you are to acquire those skills, and are you set up for success? So that's one tip that I do want to give. And another question that came in, we'll treat that as the last question. Do you have any insights or trends on voluntary turnover for 2024 thus far, less or more than 2023? Yes. Also, the Bureau of Labor Statistics follows the quits. And that's a very good indicator of people leaving voluntarily. They have separations voluntarily and involuntarily. And there you see that is in line with the labor market. So you do see that peaking in 2022 when more than 3% on a monthly basis would leave their employer. So that's very, very high. That has come down, and I think by on top of my head, I would say that's now hovering at around 2.2%. So that's still a relatively high number, but it has slowed down quite a bit. I have one more question. I'll do that. Do you see a trend on fixed employment and temp and contractors hiring? Yes, absolutely. Also, very interesting question. We see in a lot of markets globally that the amount of contractors is going down. It is hard to judge on why that's happening. The theories are there, of course, that when there's an employees market, employees can decide on what contract forms they have. And still a lot of employees value permanent contracts over temping or freelancing or any contingent basis. So yes, that is very low. In the US, for example, the penetration of contingent worker is lowest in a very long time. So that's definitely an effect that we have seen in the market. All right, that concludes the Q&A. I have one more slide for you to show a couple of things that will be happening in the next 60 days before we reconvene on this Talent Market 30. There are quite a few good conferences coming up. I do want to give a shout out to the Global Talent Intelligence Conference in Hoofddorp in the Netherlands. That's one that I'll be attending myself, and I'll be speaking there on how talent intelligence can help you to become more strategic in your company as a whole. So do want to highlight that one. A couple of publications that are coming out. We are always watching the JOLTS, so that's in the US, all the job-related indicators that they release on the 4th of September. That will be July data. And of course, that Fed decision, how much are they going to cut the rates? The expectation is now that that will be 25 to 50 basis points, of potentially half a percentage off, and for the full year, potentially a whole percentage off. So that would really make a a difference in the cost of capital. Also want to highlight one of our partners, Made by Dyslexia, who's releasing during the United Nations General Assembly the Intelligence 5.0 report on how dyslexia is an important skill for companies globally. And also, we're working behind the scenes very hard on our next iteration of our Global in-Demand Skills Report, which will also be released in October, November. So thank you very much for joining me today. I really look forward to seeing you again on our next iteration. Please sign up, and I welcome any feedback from you. And also, if you have any topics that you want us to dive a little bit deeper into, do let us know. And thank you very much.